Fisher says his recent buyers fall into three camps. At either end are first-time buyers who have never had a 3% loan, and older buyers who are paying cash. Neither is much bothered by rates around 6%, he said. In the middle are move-up buyers who initially worried about rates more. But they are making workarounds like nudists to get what they want, Fisher said. These buyers likely drove the increase in applications for new mortgages that happened as rates fell earlier this winter. People have wrapped their heads around where interest rates are, and they have adapted, Fisher said. Indeed, combining the wage gains of the last few years with the deflation that has begun to show in market-based housing data in the last 6 months, and the most flagrant cases of distorted regional markets have begun to correct already. Another boost comes from solid rates of new household formation, said Darryl Fairweather, chief economist at Redfin. Where home prices are now, the average house price is down 6% since the June peak, according to the S&P Case-Shiller index of prices in 20 major metro areas, and 3.5% in the index for the whole country. Recently, hot markets have taken bigger hits, as expected. In San Francisco, the Case-Shiller index is down 12%, in Phoenix 8%. In Sacramento, home prices have given back almost half of their COVID-era gains, said Ryan Lundquist, a local appraiser who blogs about the market in California's capital. In Metro Tampa, where prices rose 69% during COVID, according to Case-Shiller, prices are down only 3%. Add in wage growth, wages rose about 5% last year, according to data from Zillow, and the effective price of housing has come down sharply in some places, while remaining well above pre-COVID levels, Zillow chief economist Skylar Olson said. Even with values down a bit since August, if you bought the average house in February 2020 you have annual gains of 11%, Olson said. Wage growth is one reason why even in some recently hot markets, buyers are still out there, said St. Petersburg, FLA broker Jeffrey Clark. Indeed, he recently talked one client with a home in another city out of selling their place in St. Petersburg, convincing them that the crash they feared was not coming. By the NAR's numbers, affordability is now poor in Metro Tampa, with the median buyer only earning 80% of what's needed to buy the median home. But Tampa is close enough to equilibrium that Clark doesn't see anything coming like 2008 to 2011, when the average Tampa house lost half of its value. With nothing falling yet, no one is freaking out, he said. Mortgage rates and wage growth. The big flaw in the thesis that only minor price drops are coming is that so many large regional markets like Tampa remain out of line with local incomes, and many of them were in much better balance as recently as 2 years ago. Another is that San Francisco, Phoenix and Las Vegas all saw more than a 1% price drop in January alone, according to Zillow, making forecasts for relatively stable prices look shakier. Much of Florida and Texas, and markets like Asheville, NC and Denver, had relatively affordable housing until 2020, but median homes are now 20% to 30% too expensive for median local incomes, according to NAR data released in October. In much of California, NAR affordability indexes are at 50 or below, indicating homes cost twice as much as local incomes can support. But much of California has always been less affordable. Nationally, to get back to the average affordability since 1980, meaning median houses are about 20% cheaper than the median family can afford, mortgage rates would have to come down to about 4.6%, while wages would need to rise 4% and prices stay stable, the NAR's Evangelou said. Wage growth has recently cooled a little, but remains above 4%. In the recent non-farm payrolls report, wages were up 4.4% from a year ago, though a bit below the December gain of 4.6%. Mortgage rates remain volatile, and the market hopes that began 2023, that the Fed would be cutting its benchmark interest rates before year-end, have recently dimmed as the labor market and consumer remain too strong to provide confidence that the current rates hikes are doing enough to slow inflation. After falling for 5 weeks, the average contract interest rate for 30-year fixed-rate mortgages increased to 6.39% from 6.18% last week, and was as high as 6.8% on Friday. The rate was 4.05% 1 year ago. How fast could affordability get better? On a $300,000 loan, a drop in fixed rates to 4.5% from today's 6.75%, with no change in prices, would change the monthly payment by about $425 on a 30-year loan, about a 23% drop. Going to 6% cuts a payment by about $150, or 8%. A 5% income gain this year for the median buyer would add about another $400 a month. If rates come down to 5%, it gets radically better very fast, Olson said. In a place like Tampa where prices grew rapidly during COVID, the affordability fix will probably blend near stagnant prices for a year or two, pay raises and lower interest rates, Clark said. But hotter markets like Tampa may need more price cuts to get affordability all the way back to historical averages, Evangelou said. The market's standstill is likely to last for months, at least, because its main underpinnings aren't going anywhere. Sellers will continue to have the advantage of being equity rich and sitting on a low interest rate from 2021 or before, Motashami says. Some buyers will remain priced out of the market, or able to afford less house than they want. And some will use workarounds like mortgage buy-downs or parental support to buy houses until affordability recovers. Sellers of new homes will do buy-downs and have been using incentives since last summer to limit cuts to list prices. It has become kind of the norm, Nuda said. In some markets, affordability is likely to remain a problem for long enough that policy solutions will be needed, Olson said. She mentioned solutions like building more dense housing, or letting more homeowners add additional dwelling units such as basement or attic apartments to let families share costs. In most places, the likely outcome is affordability that falls somewhere between today's market, where many prospective buyers are stretched and demand is light, and the buyer's delight that prevailed for close to a decade. The path to that is rising wages, declining inflation that lets interest rates fall, and home prices that give back a still to be determined chunk of the 2021-22 gains, a share that so far is small in most places.